That winning fair value gap trade you took, the one you screenshotted and felt real good about, I hate to be the one to tell you this, but it probably wasn't the fair value gap that made you money at all. It was a supply and demand zone sitting right underneath it the whole time, and you actually took the worst version of that exact trade. I know how that sounds. Sounds like a bold thing to say, right? But I'm going to prove that to you in this video. So I'm sure by this point in your trading journey, you've heard the terms fair value gap and imbalance thrown around everywhere. But here's the problem most people run into. They don't actually know what the difference is. They don't know which one they're supposed to be trading. And worst of all, they bounce back and forth between the two, never staying consistent with either. And then they wonder why their results are all over the place. So in today's video, I'm going to fix that for you completely. And I'm going to do it for free. We're going to go all the way from what a fair value gap and an imbalance actually are, to how they're different, to the 3 exact reasons I personally trade one over the other, and then I'm going to show you on live charts exactly how I trade it step by step. By the end of this video, you're going to understand both. You're going to know which one fits you, and you're going to have a way to trade it that's rules-based and mechanical. And if you've watched my videos before, you know that's my whole thing. Because to stay consistent, we have to be objective, always. So if that sounds good to you, go ahead and smash that like button for me to help out with the YouTube algorithm. If you're new here, click that subscribe button, because we come out with content like this each and every week. And if you're already subscribed, welcome back. So without wasting much time, let's get right into the video. So before I show you which one I trade and why, we have to get one thing straight first. And that's the actual difference between a fair value gap and an imbalance. So let's start with the fair value gap. Now here's the part that trips a lot of people up. When you put a fair value gap and an imbalance side by side on a chart, they are pretty much exactly the same thing. The way we mark them is identical. The way we look at them on a chart is identical. Both of them are nothing more than an open price range. So when you get a big candle like this one, a candle that pushes hard and leaves wicks behind that never got tested, that right there is your imbalance, or your fair value gap. Let me give you a quick example so this is crystal clear. If the wick of this candle had come all the way down and retested the wick of this candle below it, then we would not have an imbalance because there'd be no open space left. But because it doesn't do that, because it leaves that gap of untested price sitting there, that's what creates the open price range. And that's true for both. Same exact thing, okay? So if they're marked the same and they look the same, where's the difference? The difference is in how you trade them. And this is where it actually gets interesting. So with a fair value gap, the idea is this. You wait for the market to retrace back into that open price range, and then you look to buy from inside of it. So in a buying example, the second price pulls back into that fair value gap. The fair value gap trader is going long. Simple as that. Now, an imbalance is a different animal. Instead of buying the moment price pulls into the range, we are waiting for the entire imbalance to get filled. So I want the whole open price range to be eaten up, and I want the market to trade all the way into the demand or supply zone sitting below or above that range. So in this same buying example, I'm not touching the range itself. I'm waiting for price to fill the whole thing, trade down into that demand, and then I look to take off from there. So do you see what's happening? We're looking at the exact same thing on the chart. The only difference is the approach you decide to take. And that approach changes everything. Because sometimes the market dips into the fair value gap and just runs away to the upside, which means the imbalance never gets filled, which means as an imbalance trader, I don't get the trade at all. But other times, that fair value gap gets completely filled. And if you bought up at the top or the midpoint of that gap, well, now you're at risk of getting stopped out when price drives below you. Or you're forced into a trade with terrible risk reward just to get a position. So both approaches have their upsides and both have their downsides. Now, me personally, I trade imbalances. This is the more old school way of doing it. Fair value gaps are honestly a pretty new term, at least as far as I'm aware. I first started seeing people talk about them maybe 2 years and a half ago. And really, it's just a slightly altered way of trading the same imbalance concept. But imbalances themselves have been around for a very long time. I've been trading them for years. So this is the way I prefer to do it. So what we're going to do now is jump over to the charts, and I'm going to show you the 3 exact reasons I lean on imbalances over fair value gaps. Now, before I get into it, I want to say this loud and clear. There is no real right or wrong way to trade here. Whether you go with fair value gaps or imbalances, both can absolutely work. I'm not here to tell you one is broken, but I am going to give you the 3 reasons I'm not a huge fan of fair value gaps and why I keep my focus on imbalances. So here we've got a big open price range. If I wanted to mark this as a fair value gap, I'd connect the wicks of the previous candles. I could use these candles right here. Or, you know what? I could use these candles over here instead. And that right there leads me into reason number 1, which is the subjectivity. So because fair value gaps can pop up in so many different spots, and you can spot these little open spaces between all kinds of candles like this one right here, they become a pretty subjective thing to trade. You kind of get to choose where you mark your fair value gap. Are you using these wicks, or are you using those wicks? See the problem? That little bit of you choose makes it awkward to stay consistent. And you've heard me say it 100 times, consistency comes from being objective. Now watch what happens when I look at this same spot through an imbalance lens instead. I don't have any worry about where exactly inside this thing the market is going to turn. My eyes are locked on the supply zone way up here. So this open price range isn't a question of where do I sell inside of it. It's just a simple rule. If this supply zone gets filled, then I look for my short. So my setup looks like this, while the fair value gap trader is over here looking for a short like this. So ask yourself, where exactly is the fair value gap trader selling from? Sure, there's the option to sell right as price enters the fair value gap, but then your stop loss has to sit either inside the supply zone, which is a dangerous place to be and gives you garbage risk reward anyway, or if you want to play it safe, you've got to push your stop all the way above the supply zone, which makes your risk reward even worse. And things don't really get much better if you use the midpoint of the fair value gap, which I see plenty of people doing. If I enter from the middle of this gap, my stop is still either sitting in a danger zone or it's still way too big. So compare that to selling from the supply or demand zone itself. When we do that, we're actually waiting on a pretty significant retracement. So if I mark this swing high down to the swing low, you're going to notice that supply and demand zones generally land around that 70 to 80% retracement level. And think about what that means. If price is pulling back 70 or 80% through a move before we enter, then we're getting in way higher up. And because we're entering higher up, our stops can be tighter and our targets can be bigger. Which brings me right into reason number 2, the risk reward. When you're entering from fair value gaps, your stop has to be either dangerous or just plain too big to squeeze meaningful risk reward out of, even when you're using those midpoints. Now, you can wait for a confirmational shift on a lower time frame inside the gap, but here's the catch. Because the market's still trading inside an imbalance, those confirmations are low probability. It's super common to see a little reversal pop up like this, and then the market just shrugs it off and keeps pushing up to tag supply anyway. So yeah, you can wait for confirmation inside a fair value gap, but a lot of the time the odds of it actually working out are still pretty slim. So that's reasons 1 and 2. The subjectivity and the weak risk reward you tend to get out of a lot of these. And reason number 3? Reason number 3 is simply that those supply and demand zones at the extremes usually end up being the better entries anyway. Most of the time, I see these fair value gap trades getting completely filled regardless. So somebody enters from the fair value gap, the trade wins, and they go, see, the fair value gap worked. But when you actually pull up their chart, their trade got a full supply or demand retest, which means they could have just traded the supply and demand zone and used the imbalance for the complete fill and gotten a better trade out of it. And this is exactly that thing I told you about at the start of the video. So let me prove it to you right now with this example on the screen. If you traded this as a fair value gap and entered down at the low, you'd be in the trade, you'd run down to about here, and then boom, you'd get stopped out. On top of that, this price action right here showed an internal break of structure, which is exactly the kind of thing that would have baited you into taking a confirmation entry, and that entry would have lost too. So whether you entered at the midpoint, entered at the low, or waited for confirmations, you pretty much would have lost this trade or had to size up a huge stop loss just to survive it. And either way, your risk reward takes the hit. But now watch this. That same move did retest supply, and it did fill the entire imbalance. So if you'd simply waited for the imbalance to fill and kept your focus on supply and demand, you'd have gotten a better entry, and you still would have gotten into the position no problem. So that winning fair value gap trade everybody loves to brag about? It was a supply and demand trade the whole time. They just took the worst version of it. So those are my three reasons: the subjectivity, the poor risk reward, and the fact that I watch these supply and demand zones and imbalances get filled the majority of the time anyway. Now, I want to be fair here, because I'm not trying to act like supply and demand is perfect. There are some downsides to it that fair value gaps actually beat. So for example, look here. The fair value gap got filled, but this supply zone did not. So after that first entry we just walked through, if you were hunting for an additional entry, you wouldn't have been able to grab one with supply and demand yet, but you would have been able to get in using the fair value gap. So I'll give it that. Fair value gaps will absolutely get you into more positions. But in my own personal experience and opinion, the positions it gets you into are lower probability and lower risk reward. And me as a trader, I would rather take fewer trades and have them be high probability, high reward trades, like the one we got up here. Plus, imbalances are so linear. When I see an open price range, I just want it filled before I do anything. It's stupidly simple and mechanical compared to fair value gaps, where you can talk yourself into seeing gaps everywhere. Let me show you what I mean. On this run up here, you could point at this small fair value gap between this candle and this candle. And it's so easy to get caught up going, well, the market's clearly going up, maybe I'll buy from this little gap. Yeah, that's not gonna work, okay? But when I look at it as an imbalance, it's clean. I just go, this imbalance is filled now, so let me go find a lower imbalance somewhere to the left, like this region right here. Simple, mechanical, easy to repeat. So how exactly do I trade imbalances then? That is the question we're going to lead into. Now, when I see an imbalance in the market, an open price range, I am always simply looking for this range to be filled. If the range is not filled, and the market reacts like a fair value gap trade, I am not going to be getting into a position, okay? I will just miss that opportunity and move on to the next. So I'm very mechanical with this, and once an imbalance is opened, I will be waiting for a fill of the imbalance to trade us towards some other area of supply or demand. Now, a demand zone is simply an indecision candle before a large upward move. You can see here we have this doji-style candle with rejections either side. Then we have this large push. If we think about what this is showing us from a buying and selling perspective, this just here is showing us an area in the market where buyers were accumulating. And then buyers took off from this level, which means a large amount of buying took place inside of this zone. And inside of this zone is then seen as a discounted price to buy from. So the price ranges around $21.65 and $21.50 are seen as a good price to buy gold for, okay? That's a good price for this asset, $2,165 per ounce. So because market participants have proven to us that they see this as a good level to buy from, indicated by the large push of bullish momentum that we saw, we can expect that if the market is to come back into this level again, more buyers will be added. Because if it's a discounted price, why would you not rebuy when the market gets there, okay? So the imbalance is therefore seen as just kind of a no man's land that is likely to be drawn through, because there's not many orders situated in here. Most of the buying and selling that's taking place is happening below or above the imbalances. In this instance, below inside of this demand zone. So a fair value gap trader may look for a buy from inside of this zone. Me personally, I'm going to be looking for a buy only when this zone has been filled. So if we allow the market to run through, you see we get a push down. We start to shift the structure to the upside, and then we lead into further buys. Now, as well as using it to identify where the market is likely to be drawn into, we can use imbalances to identify where trades are going to be taken. So here we can see structural changes in the market. When we came down into this zone, we were forming lower lows and lower highs. The lower lows stopped here. The lower highs stopped here. We had this higher low, and then we shifted into a higher high at this level. When we pulled back, we formed another higher low, and then we pushed up, and we formed another higher high. Now, from using imbalances, we could have actually found trading opportunity within this area. So as you can see, before this bearish candle formed, this large upward candle broke this internal structure range completely, and it left open an imbalance, right? The imbalance would have been from this very high down towards the low of this candle. So the imbalance that we're now working with is going to be this range. Now, as you can see following this, we had this large bearish candle, which tapped into the demand zone below. The demand zone in question is once again this indecision candle before the large upward move. This range shows us that there is buying accumulating in this area. So our demand zone would be this zone here. And now that the imbalance is filled, we would be looking for a buy. So our entry would be on the demand zone. Our stops would be below the previous low, and our targets could then continue on upwards to tackle new areas of liquidity or open imbalances. So because we're in an uptrend, we can use the highs for targets. Generally, what we could do is start using open imbalances for targets as well, but this market is trading at all-time highs, so we can't really go to the left and identify open imbalance. There isn't any, okay? So what we can do now is enter from demand once the imbalance has been filled and allowing the market to play out. You will see that we get a nice rally to the upside. So in this instance, we see the power of imbalances. There was an imbalance left open between this demand here and this candle here. Once this imbalance was filled, we reacted from demand. We didn't react from the fair value gap. We reacted from a fill of the full imbalance. Once again, when the market started to take off and shift into new highs, it was the imbalances that were completely filled that allowed us to get into our positions. It wasn't a reaction from fair value gaps. It was literally a complete fill to trade into the demand zones that we were looking to buy from. Now, I want to reiterate the point that it doesn't matter which approach you trade. Trading is a game of probabilities, and you can win regardless of which approach you decide to take. All you need to do is decide which one you prefer, which one seems the most simple and applicable to you, and then use that. So, that's all for this video, guys. I hope you enjoyed it. If you did, thanks for watching, and I'll see you in the next one.